Goldman, the latest, they look for 4 to 4.25 by year-end in 22, and maybe higher than that by the time we get through 2023. Dana, the number one pushback that Lisa gets, that I get, that Tom gets, is that we can't live with 4% rates, that this economy just can't live with it, that the debt piles is too high.
This will be the fifth rate rise this year. It's the steepest increase in rates in history, certainly since Volcker. But the background of the country today is so different than it was when Paul Volcker was chairman. We have $30 trillion of debt, the nation. The increase 1 point, if he goes 1 point on the next week, that's $300 billion of incremental interest expense.
There is yet no silver lining in the sky as the equities market, commodities market, and even the crypto market season of gloom continues. Some financial commentators are beginning to point accusations to the Fed and government for not doing enough and not responding on time to the economy that had been drowning in the past 2 years now. Peter Schiff in today's video warns investors to prepare for the mother of all recessions. He takes us through the indexes that convince him that this recession would not be a short one. If you haven't subscribed to this channel, please take a moment and subscribe. It's much appreciated. Now on to today's video.
As I'm recording this podcast on Friday afternoon, Bitcoin is back below 20,000. It's trading at about 19,700, well below the about 22,500 or so that it was at when I did my last podcast a few days ago. And I talked about that head fake rally because Bankman-Fried was making an investment in Scaramucci's Skybridge, and everybody piled into Bitcoin. And I said on the podcast that that was a selling opportunity. It was a sucker rally, and the entire rally has already reversed, and the suckers have big losses. And in fact, it wasn't just Bitcoin that the suckers were buying into. The entire bear market rally in stocks was a suckers rally. A lot of people believed that the market had bottomed, that the bear market was already over. I kept saying that it was just getting started. This is not your typical secular bear market that hangs around for a few months, maybe a year. This is a secular bear market that's going to be here for the entire decade, maybe more. Now, eventually, we may start going up in nominal terms, but not in real terms, because inflation is going to eviscerate the value of U.S. stocks. But I expected all along the U.S. stock market to roll over and ultimately make new lows. And the reason I knew it was going to go down wasn't just that I knew the market was overvalued, which it was, but I knew that inflation was going to keep surprising to the upside, and that's exactly what happened. And I also knew that the economy was going to keep surprising on the weak side, which of course that continues to happen. Now, I didn't get everything right. I thought gold prices would go up, and gold prices have come down, but I wasn't 100% convinced. I knew it wasn't a sure thing because I understood that in the short run, investors are not reacting properly to the news that I knew was coming. I knew we were getting higher inflation. I knew we were getting weaker growth, but most people didn't know that. But what's still happening is every time investors are surprised with a hotter than expected inflation number, that makes them feel that the Fed is now going to have to fight harder to bring inflation back down to 2%. Nobody doubts the Fed's resolve or its ability to bring inflation back down to 2%. So the higher inflation goes, the harder everybody expects the Fed to fight to win, and that keeps propping up the dollar, and that keeps suppressing gold.
David Henry, investment manager at Quilter Cheviot, in a recent interview, said that it was puzzling that gold was failing so much in a season of high inflation and crashing equities. He says this should have been an ideal environment for gold to rally, but gold prices have instead dipped about 4.8% within a week of the newly released CPI report. Peter Schiff also admits that gold had not performed as he had earlier predicted. Despite an avalanche of what Mr. Henry calls theoretical bulls for gold, why is gold also crashing? Is this a problem much larger than gold? Those being bullish for gold base their prediction on the history of gold, especially in the 1970 recession, when gold appreciated more than 10 times against the dollar. Things are not better on the other side of the pond. Cryptocurrencies are in a winter season as the market is hit by several factors, from the CPI report putting inflation at a high 8.3% to the Ethereum merge that only raised a lot of uncertainty for the world's second largest cryptocurrency. With Bitcoin devaluation reaching as high as 15% and Ethereum suffering an even bigger 21% loss in value. Peter Schiff tackles the issue of the economic drivers and why everything points to a major recession, which we seem not to be preparing for.
I'm confident that the only reason Powell is talking so tough on fighting inflation is that he's still delusional enough to believe that he can do it without destroying the economy. Is he willing to put the economy in a mild recession where unemployment tweaks up a little bit? Sure, why not? That would be getting out of Dodge with barely a scratch. So yes, he's willing to do that. But is he willing to create a worse financial crisis than 2008? Is he willing to put the economy into the equivalent of a depression, a great recession worse than the one we had in 2008? Of course not. He has zero tolerance for that, but he doesn't expect that. And neither does anybody else. No, it's amazing. Every time I hear somebody talking about the U.S. economy going into recession, conceding that we'll probably go into a recession, ignoring the fact that we're already in one. We've already had 2 quarters of negative GDP. So technically we're in a recession, but some people are ignoring that and they think, well, we're probably going to have a recession. But everybody says with a high degree of confidence, by the way, that the recession is going to be short and shallow. How do they know that? And why should it be short and shallow? The bust needs to be proportionate to the boom. We've never had a boom this big. We've never had interest rates this low for this long. We never had an economy more screwed up than the one we have right now. We've never had bigger asset bubbles, bigger debt bubbles, more misallocations of capital and resources. So we have more mistakes that we need to fix now than ever before. So how are we going to do that with a short, shallow recession? We're not. It's going to be a massive recession. And again, the Fed has no stomach for that. And that's why the Fed is going to pivot. But the problem is when they do pivot, it's not going to be like the pivot from 2020 because they're going to be pivoting when inflation is still well above 2%. It'll probably still be well above 4% or 5% or 6%, wherever. We're still going to have very high inflation.
The past few months have been marked with undesirable records, from record inflation to record low interest rates, then record rate hikes. In June of this year, the Fed were forced to raise rates by 75 points. This 0.75% rate hike is the most aggressive the U.S. has seen since 1994. The government also had to bring down its GDP projections from 2.8% to 1.7%, and admittance that the U.S. economy was gasping for breath. In 2020, the Congressional Budget Office released a report that informed that the U.S. domestic debt had reached 100% ratio to the nation's GDP. This is the worst debt-to-GDP ratio the U.S. has had since the end of World War II. Things have only gotten worse since then, as the debt-to-GDP ratio is now at 120%, as GDP growth slowed to 1.5%. Peter Schiff warns that the recession we're entering would not be a circular one, nor would it be a short recession. Based on the economic parameters, everything is showing that the economy would have to enter a major reset before we can begin to see a sustainable recovery. The Fed has proposed taking inflation down to 2%, but financial experts are suspecting that this would prove more difficult and take a longer time than anticipated, which would lead the Fed to pivot at a higher rate than the target 2%. Mr. Schiff puts his pivot point at about 4% inflation rate, which he believes would be a hasty move. With all the presented indexes, do you think we would see a pivot sooner, or do you think we're in for a long haul? Don't forget to hit the like button and subscribe to help the channel grow. Thanks for watching.